Good morning and welcome to Managerial Accounting. As we look at the calendar, you can see we have one item due today, and that is the Chapter 20 exercises. So we will be finishing those up during class today, so you should be able to submit those for grading ideally by the end of the day today. Just a reminder, we are having a review session tomorrow morning, and anyone is welcome to attend that. You should sign up in Starfish because that's how you get the link to the Zoom session. It is totally optional. At this point, I've had a request to go over the Chapter 19 problem. I think that's what we'll be doing at the beginning. But I would be happy to look at the Chapter 20 problem or anything else that people think would be helpful. If you have a specific idea, especially if your idea is, could we do some additional exercises from this chapter because I'm not sure I'm really getting it, please let me know that in advance if you can, because then I can get those exercises set up, give me time to look at what else is out there and get that available for us in CNOW. Other than that, as I said, it's optional. I'd be happy, the more people who are there, the better. But I will also plan to record that and make it available to people who are not able to join us tomorrow morning, but would still like to benefit from that review. Looking ahead then to next week, we'll be covering Chapter 21. And the following week, just a heads up, at the very beginning of class, we're going to have a visit from Stacy Tanner from Bellevue University. So some of you have already heard what she has to say. She'll just take a few minutes at the beginning of class. Please don't take this as permission to come late to class. That would not be polite to be logging in while she's speaking. So please make every effort to still be on time that day so you don't interrupt her few minutes presentation and so you can hear what she has to say. Even if you've heard it before, it may be something new and now relevant to you and when it wasn't maybe last semester. All right, any questions, anything you want to talk about before we pick up with Chapter 20, Exercise 6? All right. Well, let's go to that exercise then. I'm going to remind you of the formula that we had derived at the end of class on Tuesday. I'll put that on the screen for us here, just as a reminder. So remember I said the textbook treats it as if it's really two separate formulas, one for break-even number of units and one for some level of profit. And I think that's not terribly efficient. It also makes it seem more complicated than it needs to be. So we derived it as one formula, and I will explain how to use it for each one. So this is the formula that we had come up with on Tuesday. We took the contribution margin format for the income statement, where we divide our costs based on not whether they're product or period costs, as we've been doing and as we do for financial accounting purposes, but instead we divide them up based on whether they're variable or fixed costs. And so I took that contribution margin format and solved for the number of units. Okay, so number of units equals, and this is what we came up with, fixed costs plus profit divided by contribution margin per unit. I'll put the line in there for us. And we know that contribution margin per unit, and I'll write this up here just as a reminder, where contribution margin per unit is the selling price minus the variable cost. Whoops. unit. Okay, so that's what we had derived together at the end of class. We hadn't used it, but I asked you to make a note of that because we will be using that for maybe everything we do, most everything certainly, that we do for the rest of this class, the rest of this chapter, I mean. So any questions about that? Just the formula we're going to be using. So you're not going to be asked to derive it or solve the way we did together in class on Tuesday. I just wanted you to see where it was coming from, that it is based in what we already know. But if you just have this formula available, you can use it to solve the equation or the problem that we're looking at right now, which is break-even sales. And also the next step, which is, well, what if we don't want to just break even? What if we want to make some specific level of operating income, or what I've included here as profit? I think on Tuesday, I probably put in this formula OI for operating income, but it's the same thing for our purposes.
What is the UC for the
Variable cost per unit. So I said that we can use just this one formula, where the book, in my opinion, makes it seem like it's two totally separate formulas. If the company wants to break even, what does that mean? It means they don't make any money. They don't lose any money, but they don't make any money. So it is this same formula, but where profit is, we just plug in a 0. So that kind of just drops out of the formula, but it's not a whole separate formula. So let's go ahead and see how we can use this in this particular exercise. For the current year, ended March 31st, Cosgrove Company expects fixed costs of $27,600,000, a unit variable cost of $805, and a unit selling price of $1,150. We're first asked to calculate how many units do they need to sell just to break even. So if I take this formula, number of units is fixed cost, we're told is $27,600,000, plus profit of 0 because they want to just break even. So I could plug that in if I wanted to. I'm actually not going to leave it there because it's excess. We don't need that. But when we get to part B, we will be plugging the profit in there, the desired operating income. And then we divide that by the contribution margin per unit, which is the selling price of 1 million. Oh my word. Now today I'm going to say million instead of thousand. On Thursday, Tuesday I couldn't say million. Now today I apparently can't say thousand. So contribution margin per unit, as we said on Tuesday, that is what's left over of the selling price after we cover the variable costs. So remember, our definition of variable cost is those are costs that we only incur because we made that unit. So think direct materials, direct labor. If we didn't make this unit of whatever the product is, we wouldn't incur those additional direct materials, direct labor, and other variable costs. So we sell the unit for $1,150, but it costs us, if you want to think of it like that, it costs us $805 specifically for that unit. And so the difference, $345, is what's left. And that $345 is contributed toward the fixed costs. How many fixed costs do we have? 27,600,000. So how many times do we have to earn $345 in contribution margin to cover that 27,600,000 in fixed costs? That's really what we are calculating there. 27,600,000 divided by 345 is 80,000 units. That's the answer to A. We need to produce and sell 80,000 units in order to break even. Okay. So the assumption here, as I mentioned last class, we're assuming that every unit is sold for the same price. We're assuming that this company makes only one product. We are further assuming that we sell what we make, so there's no change in our level of inventory during the year. That assumption will be important when we get to a later chapter when we talk about absorption costing. So I'm just planting the seed right now. We'll get there eventually this semester. But for now, we're assuming that the company makes what they, we're assuming the company sells what they make. If we say they have to sell 80,000 units to break even, we assume they're making and selling 80,000. They make and sell the same quantity, so there's no change in their level of inventory during the year. Now, most companies are not happy with just breaking even. Of course, most companies are going to want to make a profit. So in part B, we're going to use that exact same formula, but rather than plugging in 0 for the profit, we're going to plug in the targeted operating income, the profit they hope to make. So how many units do we need to sell? How many units do we need to sell to make $5,175,000? So in this case, the first 80,000 units are going to cover the fixed cost. Every single unit we sell after that is going to contribute $345 to the bottom line, to their operating income. They make no money until they sell 80,000 units. Once they hit that break-even point, every additional unit, the 80,000 first unit, our profit is $345. The 80,000 second unit, we make a total of $690 and so on. So every unit after that, we add $345, the contribution margin, to the bottom line. So how many units would we need to sell?
95,000.
Thank you, Seth. 95,000 units. Okay, 95,000 units. Now, from an efficiency standpoint, we could have done something a little bit different. We could have, we already know you have to sell 80,000 units to break even. So we could have done this calculation to say how many additional units, and if you did that calculation on its own rather than including the fixed cost, you would come up with 15,000 additional units. $345 for each unit after 80,000, after the break-even point. If you choose to do it this way because the math is simpler, just don't forget to include the first 80,000 that were the break-even point. Because if I were to put 15,000 here, oh, and this actually, don't put that in yet. This actually says, oh yeah, never mind. Sorry. This says compute the sales, and when I first read that, I thought, oh, sales, that means sales dollars, but they have units there. So we could have been asked, whoops, we could have been asked what sales dollars, what sales level, what revenues would we need? And so how would we find that? Well, we found the units, and then to get from units to sales or revenues, we would just simply multiply by the selling price. So as always, it's important to read very carefully. And as sometimes happens, I don't read so carefully because I'm talking and writing on the screen and doing too many other things at once. So this does say sales in units. So I'm confident that we're okay with the 95,000, but please make sure you read carefully what the question is actually asking. And so we just use this formula for break even, as well as for some targeted level of profit or operating income. Any questions about how to use that formula? Okay. We'll keep going then. So since we just did this together in the last exercise, I would like to ask you to try using the formula for this exercise and for part A. So part A, using the information that's given, try that on your own. I'm going to pause the recording to allow you to try that. Once you have your answer to part A, stop and we will restart the recording, go over that, and then move on to part B. So as we look at our calculations for part A here in exercise 7, the first thing I did was calculate the contribution margin per unit, which is $3,120. And so when I plugged that into our units formula, I saw that we would need to sell 7,500 units in order to break even. And so the company might look at that and say, wow, we'd have to sell that many to break even. Maybe we need to look at changing something here because, maybe our expected sales are only 8,000. And so that means we're only making profit on the last 500 or something like that. And so in part B, we're asked, well, what if we increase the price to $8,000? We assume that nothing else changes. So with selling price increases, but all the costs remain the same. No reason to think a price increase would change our costs. And so we're going to use that same formula, but do this what if scenario. Well, what if the price increased? So if our price increases, but the costs stay the same, that would be a direct increase to the bottom line. Our price increase was $480. Our contribution margin is going to go up by $480. Our new contribution margin then is going to be $3,600. And so now we can recalculate our break-even units. Same fixed costs. Again, nothing was changed there. So 23,400,000 divided by 3,600 is 6,500 units. So our answer to part B, 6,500 units. Now, I need to say, because I told you on Tuesday, this is my favorite chapter because it is so clear how a company could use this to know better how to manage their company, how better to make decisions. We have useful information that helps us to be proactive and forecast, well, what would happen if we did this? What if we did that? We need to bring economics into this though, and it's okay if you've never taken economics. I implied, maybe even flat out said, that maybe they looked at this and said, ooh, 7,500 units, we're only going to sell 8,000 according to our sales department, that the forecast 8,000 units, maybe we should just raise the price. Basic law of demand in economics says, yes, but if we raise the price, we're going to lower the quantity that people are willing to and able to buy. So we can't make this kind of decision in a vacuum. Yes, they said all the costs stay the same, and there's no reason to think that raising our price would raise our cost, but there are other factors in this equation, like how many units do we expect to sell, and raising the price is going to impact that. So we would have to take that into account as well. That's not part of this CVP analysis, the formula that we're using right now, but it definitely needs to be part of that business decision. We can't just go around raising prices and expect consumers to continue behaving exactly the same way that they have in the past. Okay. Let me get this out of my way here. Get our green check marks in here. Any questions? So you can see how this formula would be helpful also for doing that what if analysis. What if we change this? What if we change that? What if we start using a different material and it's more expensive, but it lowers our fixed costs? Our variable costs will go up, but our fixed cost will go down, or vice versa. So there are many different ways that we can use this CVP analysis to answer questions about the management, the running of our business. All right. Oh, and I need, at this point, I want to go over to our PowerPoint as we get into the next conversation, which is, take this out of the way so people in the classroom can see. So I started out with one of the assumptions we are making here is the company makes one product and they sell everything they make and they sell it all at the same price. And in reality, that's not the way most companies work. And so our next exercise deals with what if we make more than one product? Or it even could be, what if we make one product, but we sell it in 3 different locations and each location has a different price? If you're thinking, why would that be the case? Think about if you want a gallon of milk on your way home from work or school today. If you go in the convenience store, you're going to pay one price. If you go in the grocery store, you're going to pay one price. If you go to Walmart, you're going to pay probably a different price. So hopefully it's clear that companies absolutely do sell the same product for different prices in different locations. So we need to have some way, in order to really make this CVP analysis work for us, we need to have some way to take that into account. What if we're selling one product at multiple prices or multiple products? Because each one of those multiple products or the same product at different prices is going to have a different contribution margin. And so with that different contribution margin, we can't use the formula exactly the way it is. We have to do something to tweak it, to make it work for us. In order to do that, then we have to have an idea. We have to know what our sales mix is. In other words, if we are selling 3 different products, what percentage or what portion of our sales are each of those 3 products? And with that, get my slide change here. And with that, we can see here an example of the sales mix. So this company sells 2 products. We're not going through this example, but I just wanted you to see this. This company sells 2 products and they know that 80% of their sales come from product A and 20% of their sales come from product B. In order to use this sales mix approach, we have to know with pretty good reliability what our sales mix is, and that mix can't change throughout the period that we're analyzing. So if we're looking at next year and we've done, 80% A, 20% B, if it turns out it's 60-40, it's going to impact the reliability of our analysis. So we need to know what that sales mix is and know that it's going to be relatively stable throughout the period that we're analyzing. And so what we're going to do is calculate a weighted average contribution margin. So we're going to calculate the contribution margin for each one of the products separately and then apply those weights, which are the sales mix percentages. So again, we're not going through this exercise. The example in the PowerPoint, we're going to go to our own exercise in just a moment, but I wanted you to see what they have done is take the contribution margin and weight it based on the product, the sales mix for those products. Let's go to our exercise, and you can see how it is we're going to go about this. I'm going to use the table that's already set up here. I'm just going to extend it. Okay, so I'm just going to extend this table a little bit. We're going to calculate the contribution margin per unit. We are going to put in the sales mix. And then we'll have I'm just going to abbreviate, weighted. So it's the weighted average contribution margin. So we already know how to find contribution margin per unit. We've seen that calculation in our last two exercises. The contribution margin per unit is the selling price minus the variable cost. So this company, Dragon Sports Incorporated, makes bats, baseball bats, and baseball gloves. And we can see their sales mix there. 40% of what they sell is bats, 60% is gloves. So let's find the contribution margin for bats. 90 minus 50 is $40 per bat is contributed toward their fixed costs and then hopefully a profit. Oh my word, this is. All right, this is a really dumb example, and I shouldn't even have it in here. This is ridiculous. Give me just a second, because I need to make a note. Stupidest example in the world. Oh my word. Yeah, this is a really dumb exercise, and I'm sorry that I didn't see it before. Oh my word, because the contribution margin for both products is exactly the same. So guess what? The weighted average of the two of them is going to be $40. Whoever made this exercise ought to be, as my mother-in-law used to say, this was one of her favorite expressions, the person who made this exercise ought to be horsewhipped. She liked to say that. Sorry. How does it make sense to say that it's the same? That's all right. We can go through the motions, even though we already know what the answer is going to be. It's pure foolishness. Excuse me. So looking at we have our contribution margin per unit. Just pretend they're not the same. We apply the sales mix, which is 40% bats and 60% gloves. We then multiply the contribution margin for each product by its percent of the sales mix. And it doesn't have to be a percent, it could be a fraction, it could be a decimal. But we need to know what proportion. The sales mix, we need to account for 100% or all of the products that we sell. So we couldn't do this analysis if we said, well, we sell bats and gloves, we sell some other stuff too, but bats are 30% and gloves are 17%. It wouldn't work to do that. We need to account for 100% of the product. So $40 contribution margin for the bats times 40% contributes $16 toward that weighted average contribution margin. And then we do the same thing for gloves, multiplying the contribution margin per unit of $40 times 60% is $24. And so unfortunately, as we knew before we even started this, the weighted average contribution margin is $40. Okay. Imagine just for a moment, that the contribution margin for the two products was not exactly the same. The weighted average then is going to be somewhere in between the two numbers. So if these were $30 and $40, it would be somewhere in between. Based on the sales mix, it's going to be closer to the product that has the higher percentage of sales. So if these were 30 for bats and 40 for gloves, the answer would be around $36, $37, closer to the glove portion. That contribution margin then would not be exactly the same as the contribution margin for either product. It would be somewhere in the middle. More heavily weighted toward the product that had the highest percentage in the sales mix. Everybody good so far? Even though this is a ridiculous problem? I feel very badly that I chose this problem. Foolishness. We're going to use the same formula that we already have. We're calculating break even here. We could just as easily be calculating what if we want to make X amount of profit or operating income. But they've asked us to use to calculate break even units. So it's the same formula that we've used in the previous two exercises. Fixed cost of $620,000 given in the first line, divided by the weighted average contribution margin based on the sales mix. And what I found is that we would need to sell 15,500 units to break even. Is that what everyone else got? 15,500 units to break even. And so that's our answer to letter A. How many units do they need to sell altogether? 15,500. Of those 15,500 units, we know that 40% are going to be bats. So 40% of 15,500 is 6,200. And then the rest will be baseball gloves, 60% of that total number of units. $9,300. Again, I need you to pretend for a moment that these two products do not have the same contribution margin. We need to be very careful about how we use this. You know, there's an expression about a little bit of information is dangerous. You know, someone who knows just a little bit can be really a problem. So here's what I picture. We, the accountant sitting in the back room, has done this analysis for products that do not have the same contribution margin. And we come up with that answer, 15,500 units. And so we go to the manager dude or lady and say, we've got the answer. In order to break even, we just need to sell 15,500 products. And the manager takes that little bit of information without understanding what went into the calculation and says, cool, how are we going to get to that 15,500 units? I know. Let's look at the bats, which are cheaper. And people frequently have just one glove, but have multiple bats. So let's put signs up and maybe do some advertising. We'll focus on bats because they're cheaper. What's the problem with that? Now, in this particular exercise, there's absolutely nothing wrong with that because they both have the same contribution margin. But I need you to pretend for a minute they don't. And it's likely that the cheaper product has a lower contribution margin per unit. And if that happens, and we change the sales mix, we might as well throw our analysis out the window. So we can't go to the manager and say, we just need to sell 15,500 units Because remember, one of our assumptions was that this sales mix is known and relatively stable throughout the selling period. So if we start advertising, let's go with baseballs. Okay, maybe the store sells baseballs as for manufactured baseballs. If that was part of our analysis here, we couldn't say, cool, let's just sell a whole bunch of baseballs because compared to the bats and gloves, they're super cheap and everyone needs more than one baseball. So just push baseballs. And then what happens? You sell 15,500 baseballs and you're nowhere near covering your fixed costs. And the manager looks at you and says, but you said all we had to do was sell 15,500 units. And you're saying, yeah, but the assumption we made is that the sales mix is known and stays constant or relatively constant. The farther we get away from that, the less robust, the less valid our analysis is going to be. So it is very important that you understand what goes into this, the analysis piece, the assumptions we make, that this sales mix is not going to change throughout the period. Again, for this exercise, because of this silliness, contribution margin per unit being the same for both products, it doesn't matter. It wouldn't matter how many bats and gloves we sold, as long as we sell 15,500 total. It's totally unrealistic and not very helpful. And once again, I apologize for having that exercise in this set. I feel like I should apologize for the authors of the book for allowing this travesty. Let's go on to our next exercise, which is a little more realistic. Any questions though, before we move on? Any questions on that previous silly exercise?
One question.
Yeah.
Within the equation is like the sell price minus the variable cost per unit.
Mhm.
How are we able to take that one number and put it in there?
Probably should have answered this before I cleared my. So, yeah, so, yeah, so that number that I had right here, that under the weighted average column, which normally would be different between, normally would be different between the two products, right? That weighted average contribution margin is the average that we get from each product that we sell. I think when we look at the next exercise, it's going to be more clear because we're going to have different contribution margins for each product. So let's try the next exercise and then see if that helps answer the question, or if I can clarify it better. Any other questions though on that last exercise before we try number 9? So as we frequently do, in exercise 9, we're going to be looking at a service company so that you can see that what we are doing in this chapter is helpful not only for manufacturing companies. It could be used for merchandising companies. It could also be used, as we'll see here, by a service company. So we don't actually have to make the product, because there was nothing, although we have those variable costs, and I was referring to direct materials and direct labor, the variable cost for a grocery store, is still knowable, is still discernible, and it is the cost of the product itself, right? How much did we pay our suppliers for it? So in this exercise, we're going to be looking at how do we use CVP analysis, cost volume profit analysis for a service company. It says Zero Turbulence Airline provides air transportation services between LA and Kona, Hawaii. A single Los Angeles to Kona round trip flight has the following operating statistics. I'm going to skip over that table of information for a second. It is assumed that the fuel, crew salaries, and airline depreciation are fixed regardless of the number of seats sold for the round trip flight. So these three represent our fixed costs. So I'm just going to add those together to find our total fixed costs. Those three that I just boxed in. And the total fixed costs are $13,680. You can see that we sell both business and economy class tickets. And we have the prices there for each and the variable cost per passenger. I have no idea if these are realistic or not, but looking at them, it makes me kind of scared that the business class customer costs $20 more, but they charge $500 more for the ticket. Kind of funny. So I'm going to set up a table similar to what I had on that previous exercise. I'm going to start it with, get my table here. So we have business class and economy class tickets. And I'm just going to start it in the interest of space. I'm going to start with the contribution margin per unit for each of these, rather than having separate columns for the price, variable cost. I'm just going to start with the contribution margin per unit. So for our business class ticket, what is their contribution margin per unit? Anybody have that?
660.
$660. $800 price minus $140 variable cost. How about for the economy class passenger? Right? $300 price minus $120 variable cost. That's $180 in contribution margin. Our next column is going to be the sales mix. Again, I'm just going to shorten that to mix, so that's the sales mix. And we are told right here, assume that the overall product mix is 10% business class and 90% economy. So we've covered 100% of the sales mix. If there was any other type of ticket in there, we would have to include that as well. Now we can calculate our weighted average contribution margin by multiplying the contribution margin per unit. So for business class, that's $660. That's 10% of our sales. And so 10% of 660 is $66. And 90% of 180 is $162. So now we need to add those together to find the weighted average contribution margin. 66 plus 162 is $228. Okay. Okay, so we have a weighted average contribution margin of $228. It's somewhere between the 660 that we get for each business passenger and the 180 we get from the economy class passenger. It's closer to the 180 than the 660 because 90% of our sales are 180, are the economy class. So JP, does that help you to see? So now we have just one number for the weighted average for the contribution margin that we can use in the formula. It's not the exact number for business or economy, but it's the average we get from all of our passengers.
Because the denominator is the fifth per week. So it corresponds to the variable cost. And so that's what we did for like the first.
In the units calculation that we're going to do next? Is that what you mean? The denominator in the units calculation. So we're going to use this formula, units. It's going to be break-even units is fixed cost divided by contribution margin per unit. Is that the formula you mean?
No, so it's like the first part we did for the contribution margin per unit is the 660 to 180.
Uh-huh.
That's just the result of the subtraction from the sell price minus the variable cost.
Yes.
So are we just the result of combining it into 228 and just put it right in the denominator?
So this is just the total. So there aren't, I'm sure I'm just not understanding what you're asking. This number 228 is going to go in the denominator of this calculation. Is that what you're asking?
Yep.
Yes, that is correct.
So I'm wondering if the two different calculations with 660 and 180,
Mhm.
is that they kind of say it's combining it into the 228.
Yeah. Yes, but with the weights that come from the sales mix. Yeah. So as we look then at the equation, that same break-even calculation, I already dropped out the profit part because this is break-even, so we don't have any profit or loss. We have our fixed costs that we calculated at the top line, $13,680. And then we use that now combined, averaged together contribution margin of 228. And so, excuse me, so what we learn is, in order to break even, we need to sell 60 tickets. Now we can see where the danger comes in. If we just tell our reservation people, you just need to sell 60 tickets. And so they start pushing the economy class tickets, we're going to not hit our target. We could sell 60 economy class tickets and come nowhere near covering all of our fixed costs. We need that 10% of the tickets to be the business class to get that additional $500 almost worth of contribution margin. So how many seats would we need to sell? Of the 60 tickets, 10% of them, or 6, would need to be business class, and the remaining 90%, or 54, would be economy class. If we sold 60 tickets, if we sold 60 economy class tickets, each of those contributes $180 toward the fixed cost. Our total contribution margin would be $10,800. We'd be almost $3,000 off the mark, because the assumption is we know what this sales mix is, and the sales mix stays the same throughout the period that we're analyzing. In particular, I mean, in this exercise, it's just one trip we're talking about, one flight. Okay. Any questions at this point? All right. Give me 1 second here. And we will go to our final exercise for this chapter. So it looks like we'll be finishing up a little bit early today. There's no need for us to move on to our next chapter. We have plenty of time. Yeah, we have plenty of time next week to cover chapter 21. So let's look at our final exercise for chapter 20, which is on margin of safety. So I have mentioned, I've used the term a couple times between Tuesday and today. How robust is our analysis? And by robust, I mean it holds up to changes in our assumptions. How reliable is it going to be in practice? And I've been talking about the different types of assumptions we make. In particular, in the last exercise, the last two exercises, the importance of knowing what that sales mix is, and that we maintain that same sales mix throughout the period. I've also mentioned the importance that we sell the product that we make. So if we're making product and not selling it, that changes our analysis. So the margin of safety concept is, okay, what if we're wrong? What if something does change? We're counting on this happening. How much of a cushion do we have here if something changes? So if the margin of safety is low, even a small change can shift the whole equation where we went from making money or breaking even to actually losing money. And so I would like you to make a note of the formula on this page. We'll be using it in our next exercise. Margin of safety is a calculation that can be expressed as dollars, as units, or as a percent. The formula that's on the bottom of this slide is to calculate the percent of the margin of safety. But again, it could just as easily be expressed as dollars. So how much do our sales exceed the break-even point? Or it could be expressed in units. Sales of this much equals so many units by dividing by our unit price. And again, it's a measure of how secure are we that we're actually going to meet our goals, that we're going to not lose money.
So the formula at the bottom is the percentage.
Percentage, yeah. It's a hyphen, yeah, good question. So this break even is really should be all one word. Sales at break even point is one number. So let's go to our exercise. Did everyone get a chance to get that formula down? If Canis Company with a break-even point of $960,000 in sales has actual sales of 1.2 million, what is the margin of safety expressed in dollars? So we'll start with that. The in dollars part is the numerator of that formula that I just gave you. So pretty straightforward. Sales of 1.2 million minus the break-even sales of 960,000. Again, that's the sales of 1.2 million divided by, minus the break-even sales. Well, how do they know what their break-even sales are? We've just been doing that in the last 4 exercises, calculating break-even sales in units. And we talked about at the beginning of class that to change those units into dollars, we simply need to multiply by the selling price. In the context of the sales mix problems that we did, the last two, you would calculate separately the sales revenues from each of the products that you're selling. And so we easily could do this same calculation for any one of those exercises that we just did. You know, what if their sales were this? What would be their margin of safety as a dollar amount, as a percentage? To change this dollar amount into a percentage, then we divide by the sales. So 240,000 divided by the actual sales, 1.2 million. And express that as a percentage. Okay. So what percent of our actual sales is extra, is contributing toward our profit? Now, it's not $240,000 in profit, it's $240,000 in sales. And so we would have variable costs for all the units that we sold over the break-even point. We'd still have the variable costs. So it's not, again, not 240 in profit, it's 240 in revenues is our margin of safety. Our sales could fall by 20% and we would still break even.
One question, just for the sales minus the sales break is the margin of safety, and then once you divide by the sales is the percentage.
So the margin of safety can be expressed either in dollars or as a percent of sales. And so they both expressing the same thing, which is how sure are we? How much cushion do we have there over the break-even point? We have 240,000 in sales, which is 20% of their sales. So it's really saying the same thing, but in different terms. If the margin of safety for Canis Company was 20%, if fixed costs were $1,875,000 and variable costs were 80% of sales, what was the amount of actual sales dollars? Not a big fan of this part of the exercise because it is more algebra really than accounting, but it's somewhat realistic that we could be doing this type of calculation. And so let's look at, where's my, sorry, there we go. Let's look at what do we know? You know, anytime you see an exercise like this where it feels like they're just giving you part of the information, think about what you know, think about what formulas or what equations you might know, related to this topic, that maybe we know part of this equation. Maybe we know most. Hopefully we know all but just one missing piece and we can solve for that and then see, okay, now what do we do with this? Sometimes, the answer isn't staring you in the face. Sometimes you have to kind of figure it out. And that's what I think about this exercise, that it's kind of like a hodgepodge of information that they've given us that we need to figure out, okay, what do we know here? And let's just try something and see if it works, see if it helps us. And if not, then we'll try something else. Sometimes it's trial and error to figure it out. Luckily, they give us a hint that says determine the break-even sales dollars first. Okay. So break-even sales dollars. How do we calculate break-even sales dollars? Well, break-even sales would be where profit is 0. So we could set up an equation using the contribution margin income statement format, sales minus variable cost minus fixed cost equals, we're looking for break-even dollars, so that's going to be 0. This is the same contribution margin income statement format that we introduced at the end of class on Tuesday. Well, I don't know what sales are. So we're supposed to be finding here. I don't know what variable costs are either, but we are told that variable costs are 80% of sales. So I can plug that in. for variable cost. Get rid of one of the variables anyway. Sales minus 80% of sales. Oh, but we also know our fixed costs. So just like that, I'm down to, whoops. There we go. Just like that, I am down to just one variable. If I take all of our sales and I subtract 80% of them, I'm left with the 20% that is our contribution margin. Oops. And I'm going to move that constant, 1,875,000. I'm going to add that to both sides to get that constant on the other side. I'm isolating my variable. Now what do? Divide each side by 20%. Break-even sales in dollars would need to be $9,375,000. Okay, we're part of the way there. Probably halfway there. I'm going to move this up here. It's going to run over a little bit of the stuff, but I need more room down here. Okay, everybody okay with how we found the break-even sales? Again, if you're not sure, just try something. Make sure that what you're doing is mathematically correct. Try something, and if that doesn't work, try something else. Think, okay, what else do we know here? We have our formula for margin of safety. And since that's what we're supposed to be finding here, I'm just going to put the margin of safety formula here on the board, or sorry, on the screen. Okay, so there's our formula. That's the formula I asked you to write down from the PowerPoint. Sales minus break-even sales divided by sales. We know that the margin of safety is 20%. So I'm just going to plug that in. We're told margin of safety is 20%. We don't know what their sales are. That's what we're supposed to be finding. So I'm going to leave that just as sales. What we just found, because they gave us the hint to start with that, we just found our break-even sales, 9,375,000. And I'm going to divide that by sales. And again, by thinking about what we know, what formulas do we have that incorporate some of the information here, we are able to plug into this formula, and we have it now in just one variable, so we can solve. Okay. So I just need to solve for that sales number. First thing I want to do is clear the fraction. So I want to get that sales out of the denominator. I'm going to multiply each side by, whoops, go to the next line. I'm going to multiply each side by sales. And that's what I get. I just multiplied each side by sales to clear the fraction. Need to get sales by itself. So I am going to subtract 20% of sales from each side. And I'm going to add 9,375,000 to each side. So I added 9,375,000 to each side. I'm going to subtract 20% from each side. I had 100% of sales on this right-hand side. I just subtracted 20%, so I'm left with 80%. Final step is to divide each side by 80%. I'm going to flip the sides just so I have sales at the beginning. And what I got was 11,718,750. I did the math right. Yep. 11,718,750. And if we're not sure about that, we can go back to the original equation and plug it in and see if it all makes sense. Is there margin of safety 20%? If I take the 11,718,750, subtract the break-even sales, and then divide by these sales, do I get 20%? Pretty sure we will. But you're welcome to check the math if you want to. It's what I would recommend that you do. Now, it's easy for us here in these exercises because we have that check my work button. We don't have to check it on our own, but certainly in the exam, you're not going to have a question like this on the exam. So don't let me scare you. This, as I said, is kind of a higher level of thinking because it's, you know, kind of a hodgepodge of information that's given, and we have to think about what can we do with that. So if you're looking at that part B, part A is absolutely fair game. If you're looking at part B thinking, yeah, that's kind of hard, too much going on, too much that I had to come up with on my own, I don't want you to be worried about that because that is definitely a more of an algebra question than it is an accounting question.
So for the part B, when we first started it, the sales minus variable cost minus the fixed cost.
Yep.
That doesn't make sense.
Okay, so this is what we talked about last class, and I might even be able to find a, give me 1 second here. Did I have? I can't remember where it would be, but let me, give me just a moment here to poke around and see if I can find if we have it someplace. Did I put it? Nope. All right, so let me just, and now I can't get back there. Let me just remind you of what we showed last time, and I probably should put this in the chapter 20 folder. So the contribution margin income statement, and I know it's in the PowerPoint somewhere, but I just can't quickly see where it is. The format, rather than being sales minus cost of goods sold equals gross margin minus our operating expenses equals operating income, instead of doing it that way like we've been doing since chapter 5 in financial accounting, we start with sales and we end with operating income. But what comes in the middle is the same total expenses, but we just break them up differently. Rather than looking at, is it a product cost, cost of goods sold, or a period cost, the operating expenses, instead of looking at it that way, we look at all of those costs together and say, of all these costs, which ones are fixed and which ones are variable. So these costs, fixed cost and variable cost, that represents our total cost for the period, but we're just dividing them up based on their behavior. Is it fixed or is it variable? And I plugged in the 0 here because we were looking for break even. So if we take our sales and we subtract all of our expenses, our costs, we end up with nothing left. That's the break even point. And so you could, and what we did on Tuesday was I had operating income here, but it was the same formula, except I plugged in operating income is 0 because we're looking for the break even point. Does that make sense?
Originally, I was thinking it was like a second rendition of the equation we were using before.
Oh, yeah. Yeah, it is kind of the source of that equation. So what we did at the end of class on Tuesday was we took this equation and I just solved for units. So if you have, I don't know if you take notes during class, but if you have notes from Tuesday, you'll probably find that in there. Because this is the way we came up with that units calculation that we used in the first few exercises today. So they are related. But this really is just the income statement formula. All right, anyone else with questions? Okay, so as I said, we are going to end class a little bit early today because we have covered the chapter. If anyone wants to stay and work on the homework problem or anything like that, you're welcome to do that. I'd be happy to kind of hang out in case you have questions. Other than that, remember we are having that optional group work session tomorrow morning at 9 o'clock. If you sign up in if you sign up in Starfish, you'll receive an email from Starfish with the Zoom link to join that. And I will be here on campus if anyone wanted to come to the classroom. You just need to let me know that. All right. Well, hopefully I'll see some of you tomorrow morning, and if not, I will see you on Tuesday.